Hello, welcome to another edition of the Nucleus Investment Insights. We have Leith on us with us today, so we want to talk about inflation. It's all over the news. We've seen the Aussie inflation came out a little bit higher than expected, and so we want to talk through what the implications are for that. The US aren't doing their latest inflation, and so we want to talk a little bit about that as well. And then just about the difference between what's happening in Australia and the US, and then what it means for investment portfolios from that. But with no further...
G'day, Damo.
Right, so want to talk through this whole the divide between what we're seeing in inflation. I guess maybe you want to give us a quick summary of what you thought about the inflation numbers. I'll just bring up the chart, just sort of showing the CPI and the trim mean just coming in a fair bit above expectations, and sort of we faded away, and now it looks like we're heading back up again.
Yeah, that's right. So the data obviously wasn't good. Now, I mean, do take it with a tiny grain of salt, because this is the first time they've used this new updated monthly CPI indicator. So the old one, which only covered 60% of the basket, has been replaced with this new one, which is meant to be a lot more in line with the quarterly. But even so, it's the first time that this gauge has been released. So I think the RBA for the time being will still be focusing on the quarterly inflation. But that aside, the quarterly CPI that came out last month was too high. So that had trim mean at about 3% exactly, which is top of the RBA's band. This one, the October monthly, is also too high. So it had the headline inflation at 3.8%, which is obviously way above band, and that's it was actually up from what they calculated as 3.6% for September using this new measure. But the trim mean inflation came in at 3.3%, which is also obviously above the band, and that was up from 3.2% using this new measure in September. So there is a bit of weirdness there. So obviously, according to this, the trim mean was 3.2% annual in September, whereas the quarterly was 3%. So there's a little bit of differences there, but irrespective, what it showed is that inflation's still rising, and it's still above what the RBA's band is. The trim mean is anyway, which is what the RBA looks at. That's the policy relevant one, and as a result, you can pretty much kiss rate cuts goodbye for the foreseeable future. So in my view, it's possible we will get another rate cut sometime next year, but probably not till at least the middle of the year, or at least at earliest, and that'd be require a pretty sharp tick up in unemployment, I think, the second quarter next year. But you can basically kiss goodbye to rate cuts for the time being. Inflation's too high, and the RBA is going to be very reluctant to cut unless inflation obviously comes back down or there's a spike in unemployment. And we'll probably touch on it later, but the RBA's unemployment forecasts seem very optimistic, and the RBA's kind of caught in a tug of war between price stability, which is obviously one of its mandates, to keep inflation between 2% and 3%, but also full employment. So it's trying to balance those two things, and there is likely to be opposing forces over the next year, which could force its hand. That's basically the long and the short of it.
Yeah. So, and we've sort of been running with this thought process that that a lot of what we're seeing in Australia is this idea that a lot of the main issues we've been looking at is an RBA in Australia that seems to be very focused on the inflation number and not as much on the employment and sort of wage growth, and a US Fed which is basically the opposite. And so I guess we've been talking about the RBA looking for excuses not to cut, and the Fed looking for excuses to cut. And it seems as if so we've certainly seen inflation ticking up in both countries, and the US sort of relatively self-inflicted for a lot of it, but there's sort of some I feel as if the RBA was looking for these excuses, and now it seems they've got what they're looking for.
Yeah, pretty much. So the RBA seems to have a bias towards holding, and this has given it reasons to hold. I mean, it's pretty hard to argue for a rate cut when you have an unemployment rate of 4.3%. And also you've obviously got inflation running where it is. So it's pretty hard to argue for a rate cut. And also obviously in the background, although this isn't explicitly in their mandate, they would be concerned about it. They'd be concerned about the run up in house prices as well. And also the speculative borrowing by investors and that sort of thing. So they wouldn't want to stoke those fires either. It's given them perfect cover to basically do nothing and just to sit on their hands and hold rates for however long they need to. And again, I think the one thing that could force their hand next year, assuming inflation doesn't tumble, is rising unemployment. That's the one area where they could be forced to cut down the track, but again, don't expect that for at least 6 months.
Yeah. And so I guess I've just got this chart up just showing some of the key hot areas in terms of the Australian market and housing, obviously one big one. I guess keeping in mind that in a way what's happening is in the US, they're sort of going, okay, we've got this sort of slowdown in a lot of the more general market and this massive boom going on in the AI sector. So they're trying to manage their AI boom. Whereas in Australia, we haven't really got that AI, massive spend coming through, but we do have a pretty reasonable housing, lots of inflation in the housing market and a reasonable housing bubble going on there. So that was sort of one of the biggest parts of the inflation numbers this time around.
Yeah, it is, and housing always is. It's roughly, I think it's a quarter of the inflation basket, or just under, maybe 22.5% is housing, and obviously, so just from the outset, in case people don't know, house prices aren't included in the CPI basket, but there are other things that they include, like rents, for example, and also construction costs for housing. And both those two things, so rental inflation is starting to tick up again. So, it started to come, we obviously had that massive spike once borders reopened. We had that huge, rent spike. Rental inflation then fell last year, and now it's starting to tick up again. And also the same with construction costs. So they call it new dwelling prices, which is basically the cost of building new homes. That had a huge pandemic spike when obviously, materials and that sort of thing was constricted. Getting into Australia, we had a big run up in concrete and plaster and everything that goes into building a home went through the roof. That inflation eased, and now that's picking up again as well. So those are two areas that would concern the RBA. And there are some another concerning thing is that advertised rents. So that's the way the ABS calculates rents. It's total rents paid in the market. So it's not just new rents; it's people with existing rents. But advertised rents or asking rents are like a leading indicator for that. And Cotality, which is one of the main housing data providers, and also SQM Research, they have their own series on advertised and asking rents. They're now accelerating pretty quickly. And according to Cotality, the rental vacancy rate in Australia is now back at a record low. So it's fallen to a fresh record low. We've got an absolute record shortage of the number of homes listed to rent in Australia as for a November is the lowest on record. And so we've got a really tight rental market, and those advertised rents are starting to accelerate again. That's shown by Cotality and SQM Research, and that would typically is a leading indicator for CPI rents. And so that there's just another impetus for higher inflation going ahead. Yeah. And that relates to, obviously we've still got very strong population growth, and we've got a very poor housing supply. So that's just adding more pressure into the rental market, which is going to help to put upward pressure on inflation.
Yeah, and so this is this part, isn't it, where there's, I guess the way I think about inflation numbers in particular is there's some parts of these that are demand driven, and there's other parts that are sort of shortage of supply, and then there's so economic demand driven maybe is a better word for it in terms of these, and then shortage of supply, and so you can sort of have these temporary bits where the pandemic happens and there's just not enough stuff around and we can't get it, and so prices spike just because nobody can get the stuff. Versus other times where it's like, okay, this is the supply just the prices are too low. Nobody wants to supply whatever goods at that price. We need that to go up, and so they're the ones where playing with interest rates can matter a bit. Whereas this housing problem we've got in terms of supply, look, it's just not a fast moving object, and and we've got it's got its own inflation concerns in terms of the price of goods. But as you said, it's the number of people coming in is not really an economic, like you could jack interest rates up, and if the people keep coming in, that's not going to slow that part down. Whereas in other areas it would, if that makes sense. So
yeah.
So if you're buying whatever, you're buying coffees at a coffee shop, we jack up interest rates, and the number of people wanting to buy those coffees will go down. But in terms of housing, if we're still we can jack up interest rates, but if we've still got the floodgates open in terms of people coming in, we're still not going to resolve those issues.
Yeah, especially so house prices are very influenced by interest rates because it's obviously the cost of borrowing, and it determines how much you can. It determines your serviceability and how much you can actually borrow. So whereas on the rental market, it's more a pure supply and demand thing, and so it's less related to interest rates, obviously, because you don't borrow to rent. It's more of a pure old-fashioned supply-demand situation, and we still have very, very strong demand. So the population is growing very quickly. All the sort of leading indicators suggest that net overseas migration's picked up. Whether that's the civilian labour force growth that the ABS publishes as part of its monthly labour force survey, or the net permanent long-term arrivals data that's also accelerated. So it does seem like, or indeed the rental vacancy rate, which has fallen to a record low. So it does look like we're getting more and more people coming in. Same time, the supply side, actually the ability of Australia to build homes for that growing population is constrained through these higher construction costs, through higher land prices, through shortages of labour, and also these higher interest rates. So the interest rates this decade, or currently, are higher than they were last decade, which means that it's harder to build homes, other things equal, than it was last decade. So all these factors basically just play into having a tight rental market and rising housing inflation, because that demand also feeds into construction costs to a degree as well, for building homes when there's shortages and that sort of thing. So unfortunately, it's an inflationary environment there, and that's more borne by government policy. There's not a whole lot the RBA can do about it. The RBA's only got one instrument, which is interest rates. So whereas our governments have got many levers that they could pull, but unfortunately you'd argue that they're actually pulling them the wrong way.
Yeah.
Because when you have a supply constrained market, you shouldn't pump demand. But unfortunately, they're doing that.
Yeah. Now, so okay, so that's a housing part. The food, and I guess this is US and Australia. The food seems like it's all right. There's sort of pockets that are. I mean, the US has actually probably got some bigger issues in terms of food inflation, but Australian food inflation is not dramatic. It's sort of up and down in different areas. Higher in beef and things like that, but lower in chicken, and so net it's not too bad. The eating out is still quite high, but that's relative to history. But I guess that's a bit of a feature, I guess, of the market. It's probably not going to change, but that's probably one area where interest rates probably does make a bit of a difference. You jack up interest rates, probably fewer people are eating out. But the other one that's sort of in terms of government policy, I'm just sort of wondering through as I'm looking through the numbers, like the alcohol and tobacco was a contributor. Mainly the tobacco. The alcohol actually wasn't much. But it's almost this question in the tobacco. We start. And I know this is something you write about a fair bit, but you jack up too far, and then people just start going to the black market. And if it's $1 million a cigarette in Australia, people are still going to smoke. They're not going to buy them from the shops. They're going to buy them from black markets. And I wonder, given the amount of black market stuff going on, how important you think, or how accurate the inflation numbers are for tobacco now?
Yeah, probably not very accurate, because Australia's almost in a sort of prohibition era, like the US had the 20s, whereby we've made a cigarette $2 a cigarette roughly. I think it is. I don't smoke, so I can't tell you exactly. I don't follow it that closely, but it's about $2 a cigarette. So obviously, if you can pay $2 a cigarette, or you can go to a chop shop and get the cheap imported stuff for, I think it's $10 to $15 a packet, well, you're going to do that. And there's no, so that's black market economy, and that wouldn't be measured by the ABS because it's part of the black market economy. So that is one area where I wouldn't trust the accuracy of tobacco pricing and that sort of thing, because I'm sure, for every person every pack of cigarettes sold that they gauge, where there's been high inflation, there's probably been 3 packets that have been sold on the black market, which they don't know about. So that this sort of black market economy with the tobacco trades probably distorting the CPI to a degree, but it's also probably distorting the household spending indicator from the ABS and maybe the retail sales as well, because now we've got X amount of consumption every month is now on the black market, which probably hasn't been measured, assuming it's not been measured. So yeah, it's just one of those things. And it's also a good lesson to policymakers. I mean, you can't jack up taxes too far, because eventually, when you do that, you'll end up making less money because people end up just going to the black market. And that's kind of where we're at. But anyway, that's a story for another day and a whole other topic.
Yeah, that's right. But I think the lesson I'd learned from that is then the politicians pat themselves on the back and go, look how we brought rates of smoking down because we can't see it anymore.
Yeah, well, wasn't that on The Wire? Like, I was a massive fan of The Wire when they juked the stats.
Right. Yeah.
So yeah, it's a juking the stats.
Yeah. We'll just go to a quick sales message, and then we'll want to come back and talk about energy in particular.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Okay, so I wanted to jump in and talk about energy costs. Now, we've seen I'll bring up some slides in a sec just to sort of run through this, but because we've certainly seen a lot going on in Australia in terms of we had these massive prices jump up, then we had governments shielding us from those prices. Now that's starting to flow through. The RBA has talked about looking through it before, which would then mean, are they still looking through it now, or are they not? And I think they probably overstated how much they were looking through before. Let me just jump onto this energy chart that's sort of showing just how much we've seen in terms of these. I think it's 40%. I think we're looking at annualized growth rates almost in terms of these energy prices. But theoretically, the monthly prices are actually down on the month, and so let me do your talk, Leith, and I've got a few questions about it.
Yeah, so the whole energy thing is just throwing a big spanner in the works of trying to measure the stuff. Like, it seems that nobody can actually estimate before the release exactly what the impact's going to be, because it's just so many ins and outs with subsidies. There's federal subsidies, there's state subsidies, etc. But the ABS said that annually electricity costs rose by 37% in the year to October, but actually fell on the monthly, and that was because of the timing of some rebates that came in. And if you exclude the subsidies, so just to recap, the federal government spent, I think it was about $5.8 billion or five-ish billion dollars on subsidies to basically, on rebates to basically bring down power bills, which has masked the increase of these higher electricity costs on consumers. And some of those subsidies have fallen out. So they were implemented just over a year ago, and it means that when the release comes out, the impact from a year ago drops out, and then you get a base effect where the inflation goes back up, and then there's some more. It's just very confusing. But if you excluded the impact of these rebates, the electricity price went up 5% over last year. So it just shows you how much this is all just a mess. Now, the ABS does trim out the electricity inflation so it's not included in the trim mean. It is in the headline, which is why main reason why trim mean's significantly lower, 3.3% versus, what was it, 3.8%. But these rising energy costs more generally do have second round effects. So even though the ABS can trim out the impact on a given release, as Australia as an economy has higher energy costs, whether it's gas or electricity, those costs then feed into other areas, which are then captured by the CPI. So, second round effects. So, for example, if you operate a cafe or something and your power bill goes up by, a couple $1,000s a year, eventually you're going to pass some of that onto consumers through your cup of coffee and all this other stuff. And just it's like that for pretty much every business in Australia, because every business in Australia uses energy to some degree. Some use it more than others, obviously. So if you're a manufacturer, you're highly reliant on gas and electricity. If you're a cafe, you're less. But it's an input into everything in the economy. So if we have higher gas and electricity prices, it can then lead to inflation in all these other areas. So even though the ABS can trim out the electricity price directly, it can't trim out the second round impacts that arrive down the track. And that's one of the reasons why, from a longer term perspective, that Australia is going to have sort of upward pressure on inflation, because, well, unless we sort out the gas market on the East Coast, which I don't have much confidence they're going to do, and also obviously the energy transition to renewables, et cetera, is going to drive up power bills as well.
And the other one I want to add in there, I don't know, I'm not sure, I don't know if we've spoken about it much, but I've been pushing this sort of in a lot of my stuff, is that particularly in the US, but it's flowing through to Australia now, is that, if you're renting out servers, just ballpark figures, different servers go at different rates, but, the AI servers, you rent them out for like $4 or $5 and it's costing the guy, like 50 cents. Sorry, no less than 50 cents. It's costing you like 25 cents in energy in that. And so if you double or triple the energy bill for those guys, you barely notice it. You need to go your rate from $5.50 to $6 or something like that. Like, it's not a major change. Whereas doubling or tripling for other people within the market, for if you're producing widgets, or particularly some of the Aussie ones who sort of set up here initially with low energy costs for things like fertilizers and all those types of things, that really makes a huge difference to those guys. And so, while you've got, my take was that, well, you can sort of handle an energy transition, probably, not too bad. You can handle a population growth and needing to put more of this stuff on, not too bad. You could handle switching to AI, not too bad. But when you bundle all three of them together, and all of a sudden you want this, that you just end up in this part about going, well, no, you can't get through all three of those in one go without having to sort of backslide on some of this stuff. Yeah.
No, it's a good point. So basically, it depends on what your sensitivity is to energy costs. So, I used the example of the cafe before. Well, over a year, if the electricity bill goes up $1,000, you probably go, big deal. But if you do it across the economy, and then obviously, you mentioned fertilizer makers. So we've seen sort of Incitec Pivot, for example, has downsized massively their fertilizer production in Australia because of high costs. If you're, we saw Queenos, which is our last plastic manufacturer, shut because of high energy costs. Oceanic Glass, our last, architectural glass maker, shut down because of high energy costs. All those sorts of things. So if you're a manufacturer, you tend to be very, very energy sensitive, and obviously you compete in a global environment against global manufacturers, and if Australia loses its competitive advantage in energy costs, gas and electricity, well, then it's going to have an outsized impact on those guys. But more generally, energy still feeds into everything in the supply chain. To what degree? Some areas are far less sensitive, others are more sensitive. But either way, if we have energy inflation, it's going to be inflationary for the economy more generally. Other things equal. So unfortunately, that's sort of one of the problems Australia has, I think, and not just Australia, other countries as well. But it's just, in some ways, it's probably worse for Australia because we've come from a very cheap energy background, and then we're going into an expensive energy future.
Yeah.
So the rate of change is quite extreme.
And also, we're one of the world's largest energy exporters. So,
of course,
anyone should be protected from. And we've got the world's best solar, well, not the world's best, but we're pretty close to the world's best solar resources. And our wind resources are pretty good. So, you sort of go, look, there's nothing we don't really have.
No, and if we did want to go down nuclear route, we've got 30% of the world's uranium as well. So really,
absolutely.
I mean, we should be set up to have very cheap energy on a global scale.
Yeah.
Except for, I'm not talking about oil here.
No.
But non-oil energy, we should be amongst the cheapest in the world, given the endowment that we've got. But unfortunately, we've stuffed up policy in all different areas. And then that's resulted in us giving away that advantage, which, this is a story for another day on another podcast. But in the end, when you give yourself higher energy costs than you need to, you're going to have higher inflation than you need to.
Yeah.
And you're going to have deindustrialization when you didn't need to.
Yeah. I guess. So big picture, if I look through the different markets, different areas, and I go, okay, so housing looks like inflation there is, out of the RBA's hands. It's a people-driven thing.
It's a policy issue.
Yeah, policy issue. We look at energy, and it's out of the RBA's hand. It's a policy issue. We look at goods, which is, not a huge part of it, but that's sort of. I'd probably say I'm probably slightly disappointed in terms of how high that inflation is. I was expecting sort of more dumping of Chinese products to sort of drive that,
especially
drive that down a bit.
Trump. Yeah, the Trump tariffs should have led to dumping.
Yeah, and so that's. I mean, it's not high, but it's. I guess I was expecting that to be sort of pushing out the other direction, and it hasn't yet. Yep. So we'll sort of keep an eye on that one as to what goes on there. Services is largely wages driven, and Australia's got they're bumping up against the minimum wage issues and minimum wage rises, so it's probably going to be high. It's going to be higher than average to services anyway. But maybe there's some help there if we start to see higher interest rates and unemployment ticking up. Maybe there's some relief on that. But
can I just add something on the wage thing? So private sector wages are actually so I think the private sector wage growth fell to about 3.2% in the year to September. I'm going off memory here, so it might have been 3.3, but I think it was 3.2. Whereas the public sector, or maybe it could have been 3.1 private sector, but it was significantly lower than the public sector, which I think was 3.6 or 3.7. So, interestingly, the four of the fastest areas of wage growth are all the non-market sector. So the Australian economy is basically split up into two sectors. About 1/3 of jobs, or 31% of jobs are in the non-market sector, and that's basically your public service, your healthcare and social services, so NDIS, hospitals, aged care, that sort of stuff, and then education, which is think universities and whatever. And all those sectors are mostly government funded, so they call them non-market. And wage growth in all those non-market areas is significantly higher than the private sector wage growth. So all the other areas. So private sector wages are certainly falling, or not falling. Wage growth is coming off, but at an aggregate level, it's been held up by these non-market sectors through high spending from the government, and that sort of makes it a bit less sensitive, I guess, to interest rates, because a lot of the wage growth is driven by government spending rather than the private sector, and more related to demand and that sort of thing. But there is now the federal and state governments, which are obviously have got problems with debt now. They're now trying to sort of belatedly embark on austerity measures. So the federal government's directed its departments to cut like $5 billion of spending on wages and that sort of thing. So they want to slow recruitment, have voluntary redundancies, not replace people, that sort of thing, cut back on contractors. The state governments are doing the same sort of thing. And obviously there's all this pressure to sort of curb the NDIS growth, etc. So, this gets back to what I said at the start, where I don't think the RBA I think we're likely to get rising unemployment in the year ahead, more than what the RBA expects. So the RBA basically tipped that the unemployment rate's going to remain steady all the way through to the end of 2027.
Yeah.
But
what I'm hearing from you, Leith, is that what you're saying is this is wages. There's a certain element there's a big part of it. The private sector is a big part of it. But you're saying there's also actually a big part of it that again is outside the RBA's. It's all policy driven. Policy driven. So I mean, I know Dave, our colleague, rips into the RBA a lot. I'm a bit more. I'm not as harsh on them, because the way I look at it, the RBA's got one tool, right? It's got interest rates. That's it, and it's trying to balance full employment and price stability with a single lever, which is very blunt. And whereas attacking the RBA lets the government off the hook for doing all this other stuff which it could control, whether it be it immigration or public spending or the bloat in the bureaucracy or all this sort of stuff.
So I put more of the blame on this inflationary type problem and other problems in the economy on the federal government. My only real beef with the RBA is that it's reluctant to ever call out the federal government. So it should be pressuring them in all these areas, whether it's energy policy or whatever, saying, look, it should be making public statements saying, this is making our job a lot harder. You need to do X, Y, and Z. But, maybe it does it behind the scenes, but we don't hear that publicly. So it should be sort of doing more naming and shaming. But, my view is a lot of this stuff is out of the RBA's control. It's policy driven. And unless those policies change or the government actually wants to, change this sort of stuff, the RBA is going to keep butting its head against a brick wall.
Yeah. Okay. So that's and they've got to do. I guess they've got to do more with less, if you know what I mean. Like, so if they can only control a third of the economy, or 60% of the economy can be controlled with interest rates, then they've just got to do more when they got to smash that 60%, because the other 40% it's not going to make any difference.
Yeah, and just on that, so about 80% of the job growth, or 78%, I think it was, but first quarter of 2023 to the mostly, I'm doing the labour account, the June quarter of this year was in the non-market sector. So although the non-market sector is less than 1/3 of the economy, 31.5% of jobs by memory, it's actually driven nearly 4 out of 5 jobs in the economy since the start of 2023.
Yeah.
So it's doing an outside, and this is the primary reason why Australia has an unemployment rate of 4.3%. It's because of this explosion in non-market jobs, which isn't sustainable, of course.
Yeah.
But that is, so as you said, the RBA's basically squeezing that other part, which has only created about 20% of the jobs since the start of 2023. They're getting squeezed really hard. Meanwhile, this other sector, which the RBA has very little control over, continues to be pumped by the federal government. So, the RBA is really fighting the federal government as well. And it's I would not want to be in the RBA's position, Damien, because it's Australia's kind of got a dose of stagflation at the moment. We've got very low productivity growth, terrible productivity growth, and there's a whole bunch of reasons for that. Part of it is the expansion of the non-market economy. We've got very low per capita growth. We've just had, 9 out of the last 12 quarters have been negative. We've got this stubbornly high inflation, and yet we've got rising unemployment as well. Although it's at 4.3%, it is trending up, and it's likely to go higher. So the RBA is sort of left in this situation where it's fighting stubbornly high inflation, but also rising unemployment in a low productivity, low growth economy. So it's not a great set of numbers. It's a pretty hard position they're in. They're in a tug of war.
Yeah.
They're going to be in a tug of war between price stability and rising unemployment.
Yeah.
And it's, which one's going to win? That's the thing.
Yep. Okay, so we might go quickly to one more sales message, and then we'll come back with the investment outlooks.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So the big things I want to talk about in the investment outlook is, for me, the way I'm looking at particularly the AI boom going on in the US, but it also flows back into Australia, is bubbles want cheap capital. So we had this long-term capital management in 1998, almost blew up the world economy, needed to be bailed out. We saw the US cutting rates, and that, in my mind, really helped to drive that the tech boom in the early 2000s much higher than it would have otherwise done. When you get cheap interest rates, companies can borrow. Nobody cares about the returns they're getting as much, because it's a choice between getting a 1 or 2% return on in cash, or I can get even a 5% return in some of these telco stocks, and then I'll take that 5% return. But when all of a sudden your interest rate's much higher, it makes a bit of a difference. So if you're sort of looking at the AI boom in particular at the moment, saying, well, what can cause this to go higher? Well, lower interest rates is the big thing that can make it there. In a way, if interest rates stay high, that's probably a good thing for the rest of the world economy, and it means the bubble doesn't get as big because it just means it's more constrained. I still think there's a bubble there and it'll keep getting bigger, but not as big as it'll get as if we see all these interest rate cuts. So that's sort of for me is sort of the primary way I'm looking at this. And I think that's from externally. I think within Australia, there's a little bit of sort of exposure to the AI, but not really. But it's probably more the housing market and saying, well, if we get lower interest rates, then it just means we get more useless capital bundled into high house prices in Australia and reducing productivity. So a lot of it does come back to rates. And I guess with that, Leith, I'll flip across to you. And what are you thinking on rates and what are you seeing?
Yeah, so just quickly on that, the federal government, the Reserve Bank's obviously also fighting Labor's 5% deposit scheme for first home buyers. So it's been another reason why I wouldn't want to raise rates, although it's not meant to target housing directly, but I'm sure this is in the back of its mind.
That's hasn't actually started yet, has it?
No, it started start of October.
Start of October.
Yeah.
Oh, sorry. Okay.
Yeah. So it started last month, and prices have already responded. So we've got we have a bit of, so at the moment we've got a bit of a disaster happening in the housing market, which is, surprise, it's been like for a long time. But basically investor demand is running at its highest level in a decade, at the same time as first home buyer demand is ramping up because of this 5% deposit scheme. So, and they're both chasing predominantly the lower end of the market. Right. So as a result, in October, in the first month of this, we had a big jump at the lower end. And so the RBA would be pretty nervous about that. And, my view is, the RBA is going to keep rates on hold for an extended period, several meetings. The only thing that will break it is if inflation comes right back down into target, and or we get a spike in unemployment. I still think unemployment is going to rise next year. It's going to trend higher and higher. But at what point will the RBA go, okay, unemployment is too high? So in its latest statement of monetary policy, it forecasts that unemployment is going to be 4.4%. It's currently 4.3%, all the way out to the end of 2027. So if it jumps to 4.6, 4.7, 4.8, there'll be some point where it goes, it's too high and we need to cut interest rates. But it's going to be this tug of war between, the trim mean inflation being within target or close to target and the unemployment rate being not too high. And it wants to keep it sort of there. And if the unemployment rate goes up high enough, it'll be forced to cut. Or if unemployment goes up a little bit, but inflation falls back into, around target, it'll probably cut. But we're not going to probably see anything for at least, probably till mid next year. Let's be honest. And we mightn't see anything at all. Like it could just be that they just stay on hold for longer still, maybe to the end of next year. I don't know. But
well, I guess the big question for me on that is, so let's say, and we've seen a fair bit of property news come out of China just in the last week. It's been relatively quiet there, but there's a few, capital markets are starting to rumble. Now, they can clean that up anytime they want, and I don't think they'll let it get out of control. But if we do see a weak China, and I think it's probably, China's been stronger, I guess I'd say, than I would have thought given the tariffs and everything. So, but if that does weaken at some point over the next 12 months, but the rest of the Australian economy sort of holds up as you're talking about, is that going to be enough, you think, to be cutting rates, or is that actually going to lend to a lower Aussie dollar anyway, as commodity prices come down, which is probably going to be stimulus enough and the RBA won't feel it like it needs to cut?
Yeah. I mean, it'll certainly play into their thinking. But for me, I think the number one thing to look at is actually the unemployment rate. So that'd be the area that I'd be, obviously the inflation rate as well. But I think the unemployment rate, and the other thing there also is, sort of to your point, obviously the, Simandou iron ore mines opening, or will be opening very shortly, and that's going to dump a lot of really high quality iron ore into the global market and bring down iron ore prices, and that's going to hurt. So
just for anyone, that's a huge, it's a Rio Tinto one, but it's in, or partly Rio Tinto, but it's in Africa, so it's not an Australian mine. Yeah.
Yep, and unfortunately, so it's very high quality iron ore. It's going to dump about, I think, 100 million tonnes. Not initially, it's going to ramp up to that. And, iron ore is obviously Australia's biggest export, and it's highly stimulatory for the Western Australia in particular. It also provides the federal government with heaps of revenue through, company taxes and that sort of thing. So that'll be another, I guess, negative for Australia when that ramps up and if the iron ore price plummets. But that's something to watch, late next year, I guess. But it's another thing that could factor into it, and that would, other things equal, you think would lead to lower interest rates. But I still think the bigger issue is the unemployment rate, and probably also the housing market as another thing to watch in the back end. If it keeps blowing up, and it seems to be on a very strong bull market at the moment, then it'll just be another reason for the RBA not to cut. So there are a lot of factors here. If I had to make a bet about what will be the next move, I still think the next move is more likely to be down, but just not for, probably not till at least mid next year, thereabouts. And even then, we could be having this podcast in March next year or something, and I'll change my view again because the situation would change. So that's just sort of based on what we've got right now.
Yeah, excellent. Thanks. So what that means for investment portfolios for me then is coming back to saying, well, as we look at the Aussie market and what we want to do versus international, is that it's higher interest rates here without interest rates falling with interest rates potentially falling faster in the US, or is that sort of does things to the Aussie dollar, and the Aussie dollar is probably a little bit stronger than you might have expected on one side, but on the flip side, then we'll have the commodity prices sort of making a difference to Aussie, to the Australian dollar on the other. So that's one part is balancing those higher Aussie dollar from higher interest rates versus lower Aussie dollar from falling commodity prices. So where that sort of ends up sitting. And then the other part is on a valuation basis. We're still very much have that view that the Aussie market's just expensive relative to what we can get overseas. What we're seeing in terms of international stocks at the moment is this real bifurcation. If you are in the AI sector, then you've got price to earnings ratios of 25 or 30 times. Or if you're things like Microsoft and other ones that are just heavily involved in it, even if it's not your whole business. So that quite high valuations on those, and then you got the rest of the market where things are about average, and there's even a bunch of sectors that are actually quite cheap relative to where they've been in the past. So that's your international market. The Australian market is more generally just quite expensive overall. So you don't have the AI with exposures, or certainly nothing major in the Aussie market with those high valuations. You've just got those higher valuations without that same exposure. For us, we're still sort of very much underweight the Aussie market and more overweight international, and currency is one of those big things that's going to flow through to that. Anyway, thanks everyone for coming along. Just a reminder, you can get us every Thursday, 12:30. You can get us on all the major podcast platforms. We've got those up on the screen at the moment. If you want anything more from us, you can jump on nucleuswealth.com/blog or sign up for any of our newsletters there. Got any thoughts for guests or topics, please leave them below, and make sure to hit the like and subscribe button. Thanks, everyone, and we will see you all next. And thanks in particular, Leith, for coming on, and we'll see everyone next week.